One of the hardest parts of investing is the uncertainty. Every decision carries a different level of risk and reward. And you might be wondering if you're making the right choice with your money. So, in this series, I let the risk versus reward wheel represent that uncertainty. And this wheel decides the category, then I break down the strategy. Based on the title of this video, you already know that this episode is about growth versus value. But what you don't know yet is which category the wheel will land on. Let's spin the risk versus reward wheel and see which category the wheel actually landed on. Woohoo! Large cap growth. This is actually one of my favorite asset categories. This is perfect because in the last chapter of this series, we explored large cap value and I made an investment in that category. If you missed that episode, you can watch it in the link below after this video. And today I'll compare large cap growth versus large cap value and how they behave differently and which approach might make more sense for beginner investors. Understanding the difference is important because in this series, I'm actually making real investment decisions as I grow my portfolio towards $1 million. I have over a decade of experience growing my portfolio privately. Now I'm doing it publicly. So if you're building your first portfolio and want to learn how these strategies actually work, subscribe and follow my 10 to $1 million milestone series because I publish one strategic investing lesson each week. Now let's compare growth versus value before I decide what ticker I'll invest in for large cap growth. Meet Maria and meet Bob. These two investors have different strategies. Maria's in her 30s and loves investing in fast-growing companies. On the other hand, Bob is in his 50s and brand new to investing. He wants to buy undervalued company that pays dividends. 10 years later, their results could look completely different. This is one of the first big decisions every new investor has to make. So, if you were making your first investment, would you rather own a company growing incredibly fast or a company that might be undervalued today but paying steady dividends? Because that choice is essentially the difference between growth and value. So before I make an investment, let's first understand how these two strategies work. Let me quickly define what a large cap company actually is. In the last chapter of this series, we discussed this category in more detail, but here's a quick recap. Large cap simply means companies worth 10 billion or more. Companies such as Apple, Microsoft, Amazon, and Alphabet. But even inside these large companies, there are two very different investing styles, growth and value. Let's start with growth investing. If you invest in large cap growth companies, you are paying for future potential growth. These companies often focus heavily on expanding their business by launching new products, entering new markets, investing heavily in research and development. Instead of paying large dividends, they often reinvest profits back into the company because investors believe the future could be very big. Let me give you a real-world example. Back in the early 2000s, Amazon barely made profits. Many traditional investors thought it was overpriced, but Jeff Bezos kept reinvesting money into new growth opportunities, such as cloud computing, logistics, and technology infrastructure. And investors who believed in the future growth saw Amazon grow into one of the largest companies in the world. That's the power of growth investing. So, how do investors actually identify growth stocks? Well, investors usually look for key clues. The first clue is rapid revenue growth. The second is earnings growth. The third, higher value ratios, because investors are paying for future expansion. And fourth, many growth companies reinvest profits instead of paying dividends. Let's look at a real example. A company that many investors consider a growth stock right now is NVIDIA. NVIDIA's revenue has been growing extremely fast because demand for AI chips. In its most recent fiscal year, the company reported about $215 billion in revenue, up roughly 65% from the previous year. That rapid revenue growth is one of the first clues investors look for in a growth stock. And because I love digging into the numbers, here's why that matters. Growth investors often look for companies growing sales 10 to 20% per year or faster, and NVIDIA was exceeding that during the AI boom. Second is earnings growth. As demand for AI computing has surged, NVIDIA's profits has expanded dramatically, and analysts expect earnings to continue to grow as AI infrastructure expands around the world. Third is higher valuation ratios because investors expect strong future growth. NVIDIA has often traded at higher price to earnings ratios than many traditional companies. Investors are essentially paying for a premium today because they believe the company will be significantly larger in the future. And fourth, companies like NVIDIA spend heavily on things like research and development, new chip designs, expanding data center technology, and staying ahead of AI innovation. All of that reinvestment is aimed at future growth. But here's something that surprises many investors. Growth investing can be incredibly powerful, but it also can be higher volatility. Now let's talk about the risk side of large cap growth, which is moderately high. Large cap growth stocks can be more volatile than value stocks because investors are paying for future expectations, which means they can be more sensitive to interest rate changes, more reactive to earning disappointments, and sometimes decline faster during market corrections. If future growth slows down, the stock price can adjust quickly. But the reward potential is high growth companies often lead during periods of tech innovation, strong economic expansion, new industry adoption like AI, cloud computing, or electric vehicles. Because these companies are expanding rapidly, investors expect strong long-term capital appreciation. Now let's look at the opposite approach, value investing. Value investors look for companies that appear undervalued today and often earn income through dividends. Think of it like Black Friday shopping. A high quality product is on sale. The product didn't change, the price did. That's how value investors think about stocks. Here's a simple example. Earlier this year, before the tensions in the Middle East intensified, many value investors were already watching the energy sector closely because some oil companies were trading at a relatively low valuation compared to their cash flow. ExxonMobil is one of the largest companies in the world. It produces oil and natural gas globally and generates billions of dollars in cash flow every year. Because of Exxon's strong cash flow, the company has been able to pay consistent dividends to shareholders for decades. Companies like ExxonMobil are often considered classic value stocks because they are a large, established business that generates steady cash flow and return some of that money back to investors through dividends. Value investors buy it because it's discounted. And if you're a beginner investor, you might be wondering how to determine whether a stock is growth or value using real financial metrics. Well, this is something I'll discuss step by step later in this series, so subscribe and get notified. Now let's discuss the risk versus reward for large cap value compared to large cap growth, which is very different. For large cap value, the reward potential is medium. The risk potential is also medium. Value stocks can sometimes hold up better during uncertain markets or higher interest rate environments, but they may not grow as quickly as fast expanding companies. And as I continue this series from beginner investing to intermediate, I will go deeper into dividend investing, valuation, and so much more. Now let's circle back to Maria and Bob 10 years later. If the decade was driven by innovation and rapid economic expansion, Maria's growth stocks might surge ahead. Her portfolio could be worth significantly more because those companies expand quickly. But if the decade included market corrections, rising interest rates, or economic uncertainty, Bob's value stocks might hold up better. His portfolio may grow more steadily while also generating dividend income along the way. So who wins? The surprising answer is it depends on the market cycle. Historically, growth stocks often outperform during innovation booms and low interest rates. Value stocks often outperform during recoveries and higher rate environments. Neither strategy wins forever, which is why diversification is so important. Many long-term investors hold both. Growth can provide expansion, value can provide stability and income. So for many beginner investors, the answer isn't choosing one or the other, it's understanding how both strategies work and how they can complement each other in a portfolio. So which one feels more comfortable to you? Growth or value? Let me know in the comments below. And since the wheel landed on large cap growth, the next question becomes, should beginner investors buy individual growth stocks or growth index funds? Well, I'll answer that question in the next episode. I'll show you how much money I earned from different income sources last month, then research several large cap growth options and make the next investment in this journey. And if you're new to investing and want guidance as you begin building your portfolio, I work with a limited number of people one-on-one to help you understand the fundamentals and get started, which I linked below. So if you want to follow my journey as I continue to invest toward my next milestone and see real investment decisions in real time, subscribe. And if you want to binge this series, start with Chapter 1, Episode 1. See you next week!